We cannot separate war and the conduct of war from a state's economy and its ability to finance the war. In 2022, shortly after its offensive, the Russian withdrawal from the north, from Ukraine, and from Kherson was a pivotal moment. That's when the conflict turned into a war of attrition that still continues to this day. And a war of attrition means a war of resources, human, material, and financial. And if the frontline fighter is subjected to this wear and tear, the same goes for the economy as a whole. We've already seen on the channel the major geopolitical strategies Russia uses to bypass sanctions with the help of its peripheries, the Caucasus and Central Asia, but also through Turkey, South Asia, China, India, and even Pakistan. We have seen the logistical and human support from North Korea, and that's how a regional war in Ukraine has led to upheavals that are impacting trade on an international scale. In this analysis, we will talk about the Russian economy in 2025, its budgetary choices, and its vulnerabilities.
Économique et les perspectives qui en découlent.
You'll see the situation is much more nuanced and becomes inevitable at some point. War of attrition and sanctions make it so. The way people think about the economy is no longer related to peacetime. I won't discuss the military situation either, that's not the topic here, and you can look at a map. Just keep in mind that the military and the economy are connected. It's no coincidence that the latest American-European attempt to impose a ceasefire in Ukraine is once again targeting the economy. There's the restriction on oil sales, or even targeting its partners with secondary sanctions. Russia's goal is simple: to support its ongoing military effort over time while avoiding a social and economic collapse. In an environment of Western sanctions and Western aid to Ukraine, which on the other side share these same objectives of supporting the Ukrainian effort and preventing its collapse. Welcome to Terra Bellum. Since February 2022, the Russian economy has transformed. The shock of Western sanctions has disrupted supply chains, access to technology, financial flows, and trade. Rather than shifting to a fully war-oriented economy, Russia has adopted a delicate balance between the civilian and military sectors, although the line between the two is becoming increasingly blurred, as we will see in 2023. The Russian economy had surprised with its relative resilience, with gross domestic product growth of around 4.1%, then 4.3% in 2024. What drove this growth? First, the increase in military spending. In 2022, military expenditures accounted for about 15% of total federal budget spending, then 30% in 2023, 40% in 2024, and a similar level in 2025. These expenditures are broad, ranging from recruitment campaigns and bonuses to the launch of production lines. And that's what interests us here. This table is part of Rostat's data, and it shows that industrial production plays a driving role in the growth of the Russian gross domestic product in 2023 and 2024. The significant increase in manufacturing production contributed to a third or more of the total gross domestic product growth. The weight of the military sector is, of course, not explicitly detailed in the official statistics compared to the civilian sector, while still being clearly noticeable. Tables showing the annual growth rate in 2024 in various production sectors: radio equipment, work clothing, vehicles, metal products, electronic and optical products, medical products, navigation devices, etc. We can guess that all this isn't just for counting fishing spoons. In 2025, the growth dynamic will slow down significantly, with gross domestic product increasing modestly, around 1 to 1.5% over the year. This can be partly explained by growth in industrial production in those same waters, estimated at 1.5% for the year 2025, according to forecasts, which could suggest that Russian industrial production has reached a ceiling in 2025, and that if they want to surpass it, investments in labor will be needed. We'll get to that. Growth in 2023 was also driven by trade, with the reconfiguration of internal and external flows and the increase in exchanges with Asia. In 2023, trade thus grew by 6.8%, the same in 2024, before then drastically falling to an estimated 2.5% growth in trade. Again, the reconfiguration was carried out, the domestic market stabilized, and wholesale and retail trade in Russia reached a ceiling. On the other hand, in 2024, it was the financial and insurance services that experienced very strong growth, with an increase of more than 16.5% in 2024. In general, such sustained growth in this sector can reflect several things: an increase in deposits, insurance premiums, and demand for financial products. This could mean that individuals and businesses are setting more money aside or looking to protect themselves more through insurance. And indeed, interest rates are high, which encourages saving and investment. And according to a NAFI survey, at the beginning of 2025, 42% of Russians had savings. In April 2025, the amount of Russian capital in the form of deposits and savings accounts reached the equivalent of $705 billion, double the amount compared to 2019. In short, understand that the Russian economy has changed. Adapt. This is symbolized by strong growth in 2023 and 2024. But 2025 marks the slowdown, as the ceiling has been reached. Growth will therefore be driven mainly by military and civilian production, financial services, and trade. The outlook indicates technical stagnation, with a risk of recession in 2026 if the financial environment does not ease quickly. That is, by lowering rates to encourage investment and consumption, but without overdoing it, since inflation will also need to be reduced. We'll get to that. Because the slowdown in growth is explained by three main factors. These are the usual weaknesses of the Russian economy in peacetime, which are put under strain during the wartime. We're coming back to the parallel between war and the economy. First of all, a decrease in energy revenues over the first 9 months of 2025. Hydrocarbon revenues have dropped by nearly 20%. This decrease is not explained by the volume of Russian hydrocarbon exports in 2025. They are slightly lower or about the same as those of 2024 for gas, coupled with a moderate decrease of about 4% in crude oil volumes in 2025 compared to 2024. However, the export volumes of Russian hydrocarbons in 2025 remain below the pre-war level by about 10 to 15%. But 2025 also confirms the continued pivot toward China, with India leading the way. Hydrocarbon exports should be accompanied by a significant decrease in exports to Europe, which mainly imports liquefied natural gas. Turkey is continuing its goal of becoming an energy hub for Europe. And the surprise in 2025 is that Taiwan has increased its imports of Russian oil sixfold. We can also mention Southeast Asia and Latin America. I'm talking here about hydrocarbons, which includes oil, natural gas, and petroleum products. The real cause of the drop in hydrocarbon revenues is therefore the decline in global oil prices. Dollars per barrel at the beginning of the year to about $60 per barrel, or even a little less right now. This is due to an oversupply, the slowdown in the growth of this demand, and organization of the petroleum exporting countries, plus which increased its quotas despite the situation. This is coupled with a strengthening of the ruble, which appreciated by 27% in 2025 compared to the dollar, which in fact reduced revenues from hydrocarbons. We can also note the growing efforts by the United States and European Union against the Russian shadow fleet. It would import about 59% of Russian crude oil. And what about the secondary sanctions, which have been imposed recently and will play a role in the future? There are also the Ukrainian strikes on refineries. For now, Russia's total oil production has only decreased by about 3% this year, 2025. So we'll have to see what happens in 2026. A second factor is persistent inflation and high interest rates. The Russian central bank has kept very high key interest rates since 2022, reaching 21% in 2024, before starting to drop to 17% in September 2025, then 16.5% in October 2025. This policy of raising rates aims to contain inflation. Any increase in rates limits access to credit and puts pressure on companies' investment margins, while also slowing down development. In the civil and private sectors, growth and trade are returning. And finally, thirdly, there is the eternal issue, which existed even before the war, of the labor shortage. At the end of 2024, more than 80% of Russian companies reported having difficulties recruiting. even though the unemployment rate had reached a historic low, around 2%. In May 2025, this was a sign of a tight labor market. This blow is expected to result in a shortage of several million workers by 2030. There are losses and enlistment due to the war, but above all, it's the birth rate that remains extremely low, at 1.41 children per woman in 2023. At the same time, immigration capacity is also limited, held back by social sensitivities and increased expulsions of migrants, especially following the attacks of March 2024. Russia is looking more for contractual partnerships with, for example, countries like India, which have a huge pool of workers. In 2025, the total quota of foreign workers in Russia was 235,000, with 72,000 allocated to Indian citizens, who make up 30% of the workforce. In short, peacetime problems are put under strain during wartime. Western pressure on hydrocarbons is significant, and we see that it's mainly inflation, high interest rates, and the labor shortage that are also weighing down the Russian economy. And it's on these points that the Federation will probably try to work without necessarily having guaranteed success. An interesting point to develop here is the scenarios and forecasts of the Bank of Russia, which we'll call the Bank of Russia here. How a power perceives its economic situation and seeks to change it, because this will also undeniably impact the conduct of its operations in the war, as well as their continuity, or not, in 2026 and beyond. The BDR in September 2025 published several scenarios: inflationary, risky, and an intermediate scenario, which is considered the most likely, and which we will look at here. While it is not predetermined, it gives an idea of the country's economic outlook in the times to come. The BDR anticipates an increase in oil extraction, as indicated by Organization of the Petroleum Exporting Countries, plus which will lead to a surplus. The federal bank therefore anticipates an average barrel price, which should drop to around $55 per barrel before rising again to $60 per barrel around 2027, 2028. Western sanctions will continue in the medium term. Domestic demand will be the priority and will outweigh foreign trade, although consumption and investments in 2025 and 2026 will balance out. They will be lower than in 2023 and 2024. Finally, gross domestic product growth is expected to slow to between 0.5% and 1.5% in 2026, then return to rates between 1.5% and 2.5% per year after 2027. Regarding inflation, the BDR's goal is to bring inflation below 7% by the end of 2025. We will see it very soon, and towards 4%, which is considered a normal inflation rate in Russia, by 2026. Finally, after a first rate cut in September 2025, the goal in 2026 will be to lower them towards 13%, then towards 8% in 2027-2028, which also corresponds to a normal rate in Russia. So that's the intermediate scenario anticipated by the BDR to keep it short. In this scenario, after the 2023-2024 reconfiguration, the BDR estimates that in 2025-2026, it will be at the bottom of the wave, between deceleration in the best case and stagnation in the worst case, before a return to normal economic indicators in 2027-2028. It remains to be seen what will happen in due time. This will also depend, of course, on internal and external factors, whether positive or negative, and of course on the situation in the war. And speaking of war, Russia is still far from being in a true war economy. We shouldn't confuse, as often happens, the federal budget and gross domestic product. The federal budget represents about 20 to 25% of Russia's gross domestic product and includes the state's centralized revenues and expenditures. In 2025, defense accounts for 40% of the federal budget, which corresponds to about 6 to 7% of Russia's gross domestic product, not 40% of gross domestic product, as I've seen mentioned. This proportion shows a significant military effort, but it doesn't monopolize all the country's resources. It still leaves room for civilian activity. A real war economy is, for example, World War II, where this ratio reached 35 to 40% of gross domestic product for the United States. With a full mobilization of their economy to provide a historical frame of reference, Russia would currently be in a similar position. Like the United States during the Vietnam War, where the United States spent on average about 8% of their gross domestic product during the period from 1967 to 1969, which was the most intense. Another example, since 2023, Israel's military spending represented about 8 to 9% of their gross domestic product, before decreasing to 5% of their gross domestic product in 2025. Once again, we come back to the distinction between wartime and peacetime. The Russian economy in 2025 is in a position characteristic of an economy at war, but not a war economy. A situation that confirms that despite the significant and major weight of defense in Russian growth, as well as the stagnation resulting from the war, the Kremlin's objective is still to try to conduct the war under conditions it considers optimal, while avoiding or limiting the social and economic cost of a war economy. Everything then becomes a question of how sustainable the wartime economy is for Russia, knowing that the conduct of the war will also depend on this sustainability. I've just summarized in one sentence what could lead to the end of the conflict in Ukraine. The question remains when this turning point will happen, and if it will happen at all. Now let's talk about the Russian federal budget, which represents all the revenues and expenditures of the central government, not to be confused with gross domestic product. For 2026, the federal budget would be $538 billion, with a deficit of $46 billion, which is 1.6% of gross domestic product. The Russian goal is therefore to cover the 2026 federal budget and fill this $46 billion deficit. The vice president of the BDR plans to cover the additional expenses through increased tax revenues, meaning a tax hike, rather than by increasing the deficit and debt. The goal is to limit borrowing. The reason is very simple. Russia has low debt, only 20% of its gross domestic product in 2025. But the cost of servicing this debt is high, with interest rates around 14%. Because the capital market is limited due to sanctions, which already consumes nearly 8% of the federal budget, just like the United States, except that the United States is in debt by more than 100% of its gross domestic product in 2025 and not just 20%. We come to the main measure to fill the deficit, the increase in value-added tax, which will go from 20% to 22% starting January 1, 2026. This measure will increase tax revenues by $28 billion and will thus cover 60% of the budget deficit. In 2026, value-added tax will account for 37% of federal revenues. This also comes with the value-added tax exemption threshold, the removal of certain tax exemptions, new taxes, for example on gambling, and a gradual decrease in rates in an attempt to maintain room for credit growth in the private sector. I refer you to the BDR's forecasts. But after value-added tax, there is still 40% of the budget deficit left to cover, which is $18 billion. Here, the BDR will have two options: either continue increasing the M2 money supply, that is, print money, with the risk that this contradicts the goal of lowering inflation, or draw from the National Wealth Fund. We already talked about the National Wealth Fund. It's the fund created after the 2008 crisis, which literally allows Russia to survive in the worst-case scenario for a few more years. Since 2022, Russia has continuously drawn from this sovereign fund to finance the war from 2022 to the end of 2024, where almost 50% of the assets of this fund have been used, and not to expand the stamp collection. While oil and gas revenues, the main contributors to the fund, have decreased, Russia has put mechanisms in place to strengthen this fund, notably by investing in Chinese assets, in yuan and gold, and by redirecting its reserves. Budgetary measures have also limited withdrawals from the fund in 2025 in order to rebuild it. This has allowed for stabilization and even an increase of this fund by 40%, reaching $160 billion today, enough to cover $18 billion or 40% of the budget deficit, and thus continue the war in 2022. Russia's macroeconomic indicators between 2022 and 2025 reveal an economy capable of adapting to a context of prolonged wars and the most severe sanctions in contemporary history. The country is also supporting a massive military effort while maintaining a social and economic foundation that is certainly fragile, but still functional. However, 2025 marks a turning point. Economic slowdown, deterioration of public finances, and the gradual reduction of energy revenues raise the question of medium-term sustainability. The war of attrition is happening both on the ground in Ukraine and in the economy, forcing the Kremlin to make tough decisions. Intensifying taxation, making choices between defense and social cohesion, increasing taxes with value-added tax, and so on. It aims to compensate for the loss of revenue, but it also risks increasing inflationary pressure, weighing on purchasing power, and will put social resilience to the test. Nearly a third of the population depends on social policies, which are expected to account for 16% of the federal budget in 2026. This is a key element that Russia will rely on to maintain cohesion in a tense economic and political context. So, is Russia going to collapse economically based on the indicators? That's unlikely. It still has tools at its disposal to endure for a few more years in a wartime economy. In the long term, however, it's clear that it will need more foreign investment, liquidity, and labor, and flows that, although oriented toward Asia, are less subject to Western pressure. Seeing a return to trade with the West, starting with the United States, or a collapse of the Russian economy, we're not there yet. A slowdown or even stagnation is more likely. A recovery will come from investments and infrastructure projects, but the ability to separate military effort from economic stability will also become increasingly limited as long as Russia does not return to a peacetime economy. The geopolitical environment remains unstable, but the BDR is counting on the return of normal economic indicators by 2027-2028. Is this a sign that the war is coming to an end? By that time frame, it is clear that the conflict in Ukraine is approaching a critical point where each belligerent is increasingly feeling the pressures of the war, and where every single measure on either side will have more and more consequences on the continuation of operations. The management of resources, human, financial, and logistical, will be all the more crucial because the financial and industrial capacity to support the military effort will influence the outcome of the conflict. Russia, Ukraine, the European Union, they all understand this well, and the war marathon continues. It's not for nothing that Donald Trump said it. Good luck to all. If you enjoyed this humble, handcrafted video, I hope I provided helpful insights and a good summary. I don't know how the algorithm will react given the topic of the video, so I'm counting on you to like it. Let me know in the comments if you've ever had this kind of analysis before, or if you have any feedback on what I might have missed in macroeconomics. And, of course, share it. Quentin for Terrabellum. See you next time.